So picture this. You find a crisp $20 bill tucked away in an old coat pocket. You slip into your favorite coffee shop, feel like a winner, order your usual latte, and then you check the price. $20 barely covers a fancy drink. And maybe a pastry. What on earth happened to your money's power? Well, it's all thanks to inflation. But before you roll your eyes at another boring economics lesson, I promise, by the end of this, you'll not only understand inflation, you'll feel like you've unmasked a secret villain that's been lurking in your wallet. Inflation isn't some distant concept reserved for central bankers. It's a daily force that makes your money a little less valuable each time you set it aside. It's sneakier than you think because it doesn't hit you all at once. Instead, it creeps up year after year, nibbling away at what your hard-earned dollars can buy. So let's start simple. What is inflation? At its heart, inflation just means prices rise over time. But the hidden flip side is that your money's purchasing power falls. A dollar today doesn't stretch as far tomorrow. Think of it like a balloon that slowly loses air. It still looks full, but it won't float as high. Why do prices go up? There are a few big reasons. First, supply and demand. If something becomes scarce, let's say a drought ruins half the world's coffee crop, beans cost more, farmers charge more, shops charge more, and suddenly your latte jumps $5. You're still craving coffee, but there's less of it around. Second, rising costs. When the price of oil surges, it costs more to ship almost everything. That extra cost shows up on price tags for groceries, clothes, even streaming subscriptions, because someone somewhere paid more to transport goods. Third, money supply. Governments and central banks can create money. In a healthy economy, they add just enough to keep things moving, encouraging spending and investment. But if they add too much money too fast, it chases the same amount of goods, driving prices up faster than real growth. Here's the cruel twist. As prices inch up, your cash savings shrink in value. Imagine you tucked $1,000 under your mattress. After a year of, say, 4% inflation, you'd need $1,040 just to buy what $1,000 would have bought. Last year, your mattress stash may still read $1,000, but its real power fell to the equivalent of $960. That means every year you lose a bit. Over 5 years, that $1,000 pile under the mattress could lose nearly $200 in buying power. Over a decade, you might wake up to find your solid cushion of cash doing the job of only $670 in today's terms. You might think, nonsense, I'll just park my money in a savings account that pays interest. A solid plan. Except most savings accounts offer tiny rates, often below inflation. If your bank gives you 1% interest, but inflation is 3%, you're losing 2% every year. Your balance grows on paper, but the real-world value falls. So what does this look like in everyday life? Let's follow one single dollar. 10 years ago, that dollar would buy you a bottle of water and a snack. Asterisk 5 years ago, maybe it got you a small coffee. Asterisk today, it covers only a fraction of that same coffee. You need nearly $2 for the same treat. That's inflation at work. It doesn't wreck your wallet with a single swipe. It erodes slowly, like sand slipping through your fingers. And it's not just fun and coffee. Rent climbs, groceries climb, utilities climb, everything climbs. Meanwhile, if your paycheck doesn't rise faster than prices, you're effectively taking a pay cut. It's the biggest silent pay cut you never applied for. Now, before you panic and stuff cash into tin cans, here's the empowering truth. You can fight back. You can't stop inflation, but you can outpace it. First, grow your money. Investing wisely is the most common strategy. Historically, the stock market has averaged returns above inflation around 7 to 10% per year over the long term. Real estate can appreciate faster than prices too, even certain bonds, commodities, or inflation-protected securities can help keep pace. Second, diversify. Don't put every dollar into one type of investment. Spread it across stocks, bonds, real estate, maybe even a small slice of commodities. Different assets react differently to inflation. A diverse mix smooths out the bumps, so one inflationary spike doesn't wipe you out. Third, earn more than you spend. That might sound obvious, but it's a powerful guardrail. Track your inflows and outflows. Budgeting isn't glamorous, but it helps you spot where overspending may be outpacing raises or returns. If your lifestyle costs rise every year exactly with inflation, you break even but you won't get ahead. Fourth, keep learning. The more you understand economic trends, the better you can adjust. Watch interest rate changes, follow consumer price indexes, read up on policy decisions by central banks. Knowledge doesn't cost money, but it can protect your money. Let's see a real-life comparison. Imagine two folks, Alex and Casey, both start with $10,000 saved when they're 25. Alex tucks the cash into a plain savings account paying 1%. Casey puts the money into a diversified investment portfolio averaging a 7% annual return. After 30 years, Alex's $10,000 grows to about $13,400, but with average inflation of 3%. Its real value is more like $6,500 in today's terms. Casey's $10,000 balloons to around $76,000 with inflation. That's still about $37,000 of real purchasing power. Same starting point, same period, but very different outcomes because one strategy outran inflation and the other got swallowed by it. Now, before you jump into high-risk schemes, remember, higher returns often mean higher volatility. Protect your core holdings with safer assets bonds, stable dividend stocks, real estate. Reserve only a portion of your portfolio for riskier bets. Balance growth and safety. Another weapon in your arsenal is tax-aware investing. Maximize tax-advantaged accounts, retirement plans, health savings accounts, education savings. When you shield part of your gains from taxes, your net returns improve, helping you keep pace with rising prices. And don't forget controlling what you can. Shop smart, use price apps, clip coupons, buy in bulk when it truly saves money. Small savings on groceries free up dollars you can invest. Reduce debt. High-interest credit cards are a one-way ticket to losing money faster than inflation can steal it. Pay them down aggressively. One more point, not all inflation is bad. A little inflation shows the economy's humming, people spending, businesses investing, jobs growing. Deflation, prices falling, can be even worse. It discourages spending and can drag an economy into stagnation. Central banks usually target around 2% inflation. That modest level keeps things moving without eroding value too quickly. Trouble comes when inflation accelerates beyond control, say, above 5% for extended periods, or tumbles into double digits, where prices surge unpredictably. We've seen examples. Hyperinflation in historical cases like Weimar Germany, Argentina's many crises, or more recently Venezuela and Zimbabwe. In those extremes, people lost faith in money. They traded it for anything tangible: gold, goods, foreign currency, even wheelbarrows full of cash to buy a loaf of bread. That's inflation unleashed, a chaos you definitely want to avoid. Thankfully, most modern economies have safeguards: independent central banks, monetary policies, inflation-indexed bonds to keep runaway inflation rare. But the everyday creep is always there, and it's up to you to guard your money. So let's recap. Inflation is the slow thief in your pockets, making everything cost more while your cash buys less. It works through supply and demand, rising costs, and money supply increases. Left unchecked, it quietly erodes your savings and payslip year after year. But you can fight back, invest for growth, diversify to manage risk, earn more than you spend, and stay informed. Use tax-advantaged accounts, cut high-interest debt, shop wisely, and lean on assets that historically outpace rising prices. Think of it this way: inflation is the tide. It comes in whether you're ready or not. You can't stop the tide, but you can learn to surf. Ride the waves of investing, and you'll stay above water, maybe even catch some air. Next time you find that old $20 bill in your coat, don't curse inflation. Smile, pocket that knowledge, and decide whether you'll let it sit or let it work for you. Because once you understand inflation, you've taken the first step toward keeping your money's power intact. And that, my friends, is how inflation really destroys you, how you can protect your money. Thanks for listening. Now go forth, outsmart inflation, and give your dollars the chance to grow. It turns out the best defense against inflation is an informed defense.